Hello, and welcome to J. Mike Mortgage. And on this episode, why is my mortgage credit score different? It happens all the time. Borrower pulls their own credit report. They see one credit score number. They apply for a mortgage. The mortgage lender pulls their own credit report and comes up with a different credit score, which is usually lower. What's going on? I'm going to explain it in 4 sections. Initially, I'm going to answer the question why your mortgage credit score is different than the credit score you're likely to see when you pull your own report off the internet. Next, I'm going to go over a brief history of credit scores, then explain exactly what credit scoring formula the mortgage industry is using. And finally, I'm going to answer the question, why is it so hard for the mortgage industry to change the credit score system it uses? If you enjoy this video, please help my channel by hitting like and leave me a comment. So why is my mortgage credit score different than the score I get off the internet? Well, the simple reason is because this credit score that you see on the internet is calculated using a different credit scoring formula compared to the credit score that the mortgage company gets when they pull their credit report. And unfortunately, they just don't match. It's sort of like trying to compare yards to meters. They're similar, but not the same. And yes, it would be easy if you only had one credit score and everybody used that, but unfortunately, it's more complicated. Now, results will vary. But in general, what I normally see is a mortgage credit score that's lower than the credit score that the borrower gets when they pull their own credit report off the internet. It's not unusual to see a difference of 20 or 30 points, but that can vary a lot. And every once in a while, I've actually pulled a credit report where the mortgage credit score was slightly higher. Unfortunately, there's no known way for you to take the credit score that you see on the internet and somehow convert that into a mortgage credit score. Getting your mortgage credit score can be difficult. You either need to get it from a mortgage lender, say through a pre-qualification, or you have to get it directly from the FICO company. But in order to do that, you've got to sign up for a monthly subscription service through their website, myfico.com. My advice in general is, if the credit score that you see on the internet, if that's not, say, 20 or 30 points higher than the credit score that you need for your mortgage credit report, I would encourage you to get pre-qualified from a mortgage lender to find out what your mortgage credit score actually is. At the end of 2025, the industry is going to start transitioning to a new credit scoring system, allegedly, but there's no known completion date for that, so we may be stuck with the current system for a while. It's important to understand the purpose of credit scores. Credit scores are a statistical thing over a large group of people on average that tries to predict how likely you are to pay your bills on time in the future, based on how you've paid your bills in the past. As time goes on, the two companies that create credit scores keep issuing new and improved versions. Over the last 35 years or so, more than 20 different credit scoring formulas have been introduced. While all of these are similar, they won't necessarily produce the same number. Credit scoring was started by these two guys right here. Bill Fair, a computer guy, he got together with Earl Isaac, who was a statistics expert, and they formed a company called the Fair-Isaac Company, also known as FICO. And FICO created the credit scoring formula that the mortgage industry still uses today. The information to calculate the FICO credit scores comes from the 3 credit bureaus, Experian, TransUnion, and Equifax. One thing to understand about the mortgage business without giving you too much information is about 70% of all mortgage loans that are created are sold to one of these two organizations here, Fannie Mae or Freddie Mac. And in order for Fannie Mae and Freddie Mac to buy a mortgage loan, it has to meet their standards. In 1989, they started a transition to using credit scoring. However, it wasn't mandatory until 1995. The three credit bureaus, in order for them to put a FICO score on their credit report, they have to buy it from the FICO company, and they don't like that. So in 2006, they got together and formed their own credit scoring system that they call Vantage. Vantage is a FICO-like system. It has a similar scoring range, that sort of thing, but that doesn't necessarily mean it's going to give you the same number. So just how is your mortgage credit score calculated? Well, as of the date this video is being made, which is late November 2024, the mortgage industry is still using the same three FICO credit scoring formulas that they were using in 1989. Right now, the lender will pull a credit report with all three credit bureaus on it, and for your experience score, they'll use the FICO 2 credit scoring formula. To calculate your TransUnion score, they'll use the FICO 4 formula, and for the Equifax score, they'll use the FICO 5 formula. Then they'll take whatever number is numerically in the middle, and that will be your mortgage credit score, regardless of what bureau it comes from. So if your scores were, say, 600, 605, or 620, then 605 would be considered your mortgage credit score. These old credit scoring models that the mortgage industry still uses are considered by some people to be somewhat obsolete. The main defect with FICO 2, 4, and 5 is they don't give someone much, if any, credit for paying installment debt down early. Now, what am I talking about? Debt comes in two different types. One is called an installment loan. That's like a car loan, where you borrow all the money up front and you make fixed payments. If you send in extra money on your installment loan, they don't lower the monthly payment. You just pay the account off early. The other kind of credit is called revolving. That's typically a credit card, although it could be a line of credit. And with revolving credit, your payment will go up and down as your balance goes up and down. Now, both of the credit scoring formulas, the old ones, 2, 4, and 5, and the new, more modern ones that you see, will give a borrower credit normally if they pay down their revolving debt, assuming they owe more than about 30% of the credit limit. However, FICO 2, 4, and 5 will generally not give someone much, if any, boost for paying off installment debt, like a car loan, early. That's considered a defect in that system, and that's one of the main reasons why they're trying to transition to a new credit scoring system. Beginning in late 2025, the industry is supposed to start to transition to the use of FICO 10T or the Vantage 4 formula. But, there's no telling how long it's going to take to complete that transition. When credit scores were first made available in '89, it was 6 years before Fannie Mae and Freddie Mac made a particular version mandatory. As I mentioned in my last section, the mortgage industry is still using the same three FICO 2, 4, and 5 formulas that they started with in 1989, and they haven't updated. Well, why is that? As I mentioned before, there's this thing out there called Fannie Mae and Freddie Mac, and they buy loans from lenders, then they sell them to investors in bulk in big things called pools. Just like you have a gaggle of geese and a pack of dogs, you've got a pool of mortgages. And a pool of mortgages may contain hundreds or maybe even thousands of individual loans. Now, someone buying this or buying a share in it doesn't have the time to sit down and look at each individual loan to determine its quality. So they depend upon a credit scoring standard. And once one has been established, like FICO 2, 4, and 5, it's just very difficult to get everyone to agree to change it. I'm sure it'll happen at some point in time, but I don't know exactly when. Thank you very much for watching this video all the way to the end. If you've enjoyed it, please hit like and subscribe and leave me a YouTube comment. That helps. Thank you so much. This is J. Mike Perkins.